Let's do some calls. Carmax, top on our list today, upgraded to overweight at Stevens. Price target 90, was 86. They say management's well tenured and disciplined. You've owned the stock for a while, right?
Yeah, it hasn't been a great stock. So we think that business is starting to improve. We've had 9 quarters now where volumes of used cars, which is what they sell, have been up, positive growth. You're also starting to see prices of used cars come down. During COVID, of course, prices went sky high, and it was ridiculous. No one bought used cars. No one really wanted to buy cars. They weren't driving that much, and then they started to, and the new car market moved much faster. So we see this as an opportunity in the stock because it's starting to act better, and volumes are picking up, and that should be good for the next several quarters.
All right, Trade Desk upgraded today. CFRA, Joe, they're bullish on the valuation. The stock's pulled back a lot, right?
Oh, the stock has pulled back.
So,
okay.
So the valuation is more attractive at this point, according to them. They also say a potential Alphabet ad tech sale could create upside.
Okay, so of course the valuations will be more attractive when the stock is literally in free fall. We had this conversation coming back from President's Day when I returned from Minneapolis. Josh, yourself, and I talked about this, and I said you have to have a risk management strategy. Now, it is in the JOTI ETF. The ownership there is 43 basis points. It's the third smallest position we have. But when a stock goes from 120 down to 80 after earnings, sits at 80 on February 19th, and you don't acknowledge that you have to do something with your position, I'm sorry, that's not implementing a risk management strategy. Here we are today at $59. Okay, you could say the valuation looks good. I disagree with that. The only thing good about this is the revenue growth, and I can't wait. Maybe at some point it comes off the books on the JOTI.
I was going to say
maybe at some point. I was going to
say the only good thing about this is that we're almost at the end of the month and the quarter. You staying with this thing?
Yeah, it's in our
dogged it out so bad.
I know he dogged it, man. I said last time I was on that this company is officially in a 2-quarter penalty box for us because in their quarterly earnings, the CEO and their CFO were not great about vision going forward, and that really worries me. But we love the longer-term thematics of that type of business with the Google business and the online advertising. We think that's where this is going, this future, and we think they're one of the best at doing it. So we're going to wait and see.
Okay, 2 quarters. You let us know. Total Energy's upgraded to buy at Citi today, Jen.
Right. So Total and Shell, both really great global energy leaders, and they benefit from Europe's demand for energy. They're really focused on LNG. But here's, again, not that exciting, but what's important about them. Shell trades at 9 times earnings with a 12% free cash flow yield and almost 4% dividend. Total trades at 8 times earnings, 10% free cash flow yield, and a nearly 6% dividend yield. So they have huge free cash flow. They can buy back shares. There's not a huge earnings growth story here, just free cash flow and endless demand for what they produce.
I'm sorry, I just want to get Shell in there too, because that was buy at B of A.
Yeah, sorry, it's kind of the same story, just Europe demand for energy.
Okay.